Hey everybody, good to be here. It's Wednesday, time for managing an options portfolio. And you know what? We do this each week and we talk about options management. I also like to cover some other topics that are very associated with options management, and that is when to enter, when to exit. And of course, these aren't recommendations, but these are just, I'm trying to educate you so you can make the best decisions for yourself. I'm joined alongside by Mr. Ben Watson in the chat. I appreciate Ben. He's very knowledgeable. I've been working for Ben over 20 years now, and it's been he's very knowledgeable. And so I encourage you to check out some of his webcasts as well, including he has a trading index options webcast, a market movers webcast. I can't guarantee you much in terms of what we do, but I can guarantee you pretty much you're going to learn something if you watch Ben. So make sure you check that out. You can follow either of us on X at BrentMooreCS, at Ben Watson CS. Let's hit up some disclosures and we'll get to the main subject at hand here. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. And it's not an individual recommendation of any security strategy or chart pattern. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money software application is for educational purposes only. I may not factor in commissions in these trades that we look at, but just realize those are a real thing that you need to think about. All investing involves risk, including risk of loss of your principal. And rolling strategies can entail additional transaction costs. Past performance of any security or strategy is not a guarantee of future results or success, and probability analysis results shown, I'm going to show some here, are theoretical in nature, are not guaranteed. All right, let's head on over. So this is the Thinkorswim desktop platform. I welcome a lot of familiar names in the chat and some not so familiar. We're glad to have you too. And if you're watching on a recording, not even on the chat, that's okay too. We're glad to have you, or just glad that you're watching us. Okay. All right. Hey, I have a chart of Apple here. And my point with this chart of Apple isn't, I don't plan on doing a trade on Apple here. But my point is, when we look at a stock, it doesn't matter the stock, you can see it on other stocks too. They go up and then they retrace after they make a move. They go up and then they kind of retrace after they make a move. And so they move around, they bounce up and down. And whatever you think a stock is going to do, if it goes for you, it's likely to reverse and maybe turn against you a little bit. Or if it goes against you, it's likely to turn and go for you at some point. I can't make guarantees. Sometimes stocks just go up and up and up. I was looking earlier today at CoreWeave, CRWV, I think, if I got the ticker right. And this is one that just kind of goes up and up, it seems like. But even on these kind of extreme parabolic moves, a lot of times you get little pullbacks along the way. But my point here, and let me just do another one. Here's CrowdStrike. Just had earnings on CrowdStrike off in the news. Big cybersecurity company. But even with that, goes up, moves, it goes, it doesn't move in a straight line here. So here's my point. My point is, sometimes our expectations of what's going to happen, we need to be a little bit more patient along the way for it to happen. So let me give you an example. I'm going to focus on short verticals here to start. If we look at a short vertical, let's take a look at PayPal here. Okay, I'm going to look at PayPal, and we can do bullish or bearish examples. I'm going to consider this more of a bullish stock. We have broken above our 50-day moving average. That's in blue. We broke above our 20-day moving average. We retested it, but we've now bounced back above it. The general trend has switched from going down, where it significantly was, and going up. Let's say we were doing a short put vertical on this. And we looked at this, and so let's just look at the trade tab. And I'm going to go to July 3rd on this, about a month, which we often do, very often in this class when we're trading short verticals. We'll go out roughly in the time frame of a month, maybe a little less, maybe a lot less even, maybe more, but often that's kind of a starting point that we'll look at. But what I want to do is consider from a short put vertical. Often what we'll do is we'll use delta as a guide, delta, and you can change whatever, these columns here, these are clickable columns, and you can change what you have up here. I have delta here. Often we'll use delta as a guide of trying to give us a probability analysis. When we do charts, we're doing a technical analysis. This is more of a probability analysis. Now, delta tells us how much the option is going to move, approximately, in relationship to a $1 move in the underlying stock. But it also can be used as a kind of to give us a sense of the probability of that option expiring in the money. Okay? So let's look at this. Okay. Delta, and I also have a column that's probability in the money here. It's a little bit cut off, but probability in the money here. Let's just compare these two. 25 delta, 28% probability in the money. These are both statistical ways of doing it. They're not guarantees, either one. 33%, 30.3, 36, 39. So roughly a 3% difference. Now, it's not always going to be a 3% difference, but that gives you kind of an idea of, that's why sometimes we'll kind of use delta as a sense for the probability of it being in the money. If we're talking about a short put vertical, which is what I'm talking about right now, what we want the stock to stay out of the money typically, right? Right now, PayPal is at 72.70. And if we pick a stock that is, say, at a 33 probability in the money, that's a 70 delta, that means there's roughly a 33% chance it goes in the money, roughly a 67% chance it stays out of the money. We want it to stay out of the money. Fair enough. Okay. But here's the thing. We can do that, and just because we say 33, 34, it just changed, 34% chance that it goes in the money. That's in the money at expiration. Key point. At expiration. What's the probability along the way, though, that this trade actually hits that 70 level? Well, we don't really want it to. We don't want it to go below there. Well, I have another column here. This column is called probability of touching. Okay, probability of touching. You can add that column just like the others. Look at what that probability of touching is. About 66, 67% chance. In other words, we're looking at this and saying this is a high probability trade. It's unlikely to end up below $70, but along the way, more than likely, just from a statistical measure, more than likely, it is going to hit that 70 level. It's going to reverse and hit that 70 level. So I think if you go in with that expectation, that is, we're kind of just setting expectations. We're defining the relationship here. TTR is what they say. We're defining the relationship with this trade and realize there's a good chance it's going to actually work against us a little bit at some point. Okay? Now, here's something I'd point out, and I know those of you who've watched me before, maybe you've seen me do this before, but look at the relationship between the probability in the money and the probability of touching. Okay? I'll just pull out a few just to give you kind of a something to look at here. Look at the relationship between column A, we'll call that column A, and column B. What is the relationship there between those two? Can you see that? The probability of touching compared to the probability of in the money. What's the relationship there? Here's a hint. There's a little delay in the chat between when you type in and when I see it, but it's going to basically be 2 times that probability of touching, or as WS Trader said, this is about half. So yeah, B equals 2A, right? You got it. This is 1/2 of this, or this is twice as much as that. And that is not a fluke on this stock. If you pull up any stock there, when we're talking about in the money and these are out of the money, they're going to be, you're going to have that relationship. Okay. So when we do these, what we're probably not, what we're not going to do in this class, in this webcast, is we're not going to say, oh, if it goes down and hits that 70 level, let's say we do the short strike at the 70 level, we're not necessarily going to get out just at the 70 level, just because it's very likely it's going to hit that 70 level. All right? Because it's very likely it's going to hit that 70 level. If you think of a starting point, I'm going to start, point A is their starting point. Okay, here's our point A as a starting point. And just from a statistical measure, the odds of it staying above a certain level there, that's great. But why is the probability of touching so high? Well, there's a good, we'll just say it's 50-50 whether the stock goes up or down. I'm not going to factor in trend or anything like that. 50-50 whether that stock goes down. But even if it goes against you, okay, even if it goes against you, this is going what I was getting at before, there's a pretty good chance it's going to reverse itself, okay? There's a very good chance it's going to reverse itself. Now, there's a survey link in the chat. We appreciate your feedback. And you know what? That if there's topics, you know, it has to be within the realm of what we cover in this class, sort of, you know. I can't talk about futures in this class, but if there's topics you want to see or something, feel free to put those in the survey link, the survey as well. And I read those, and sometimes I incorporate those in here too, okay? So here's the thing. Let's look at PayPal, okay? And I said the 70 strike is about 33% chance probability in the money. Well, does 70 strike make sense? I'm just going to draw a line at that 70 level. Okay, here's the 70 level. Does that make sense? Well, yeah, I mean, if the trend is up, this is support. This is roughly where we're going. What I'm saying is we're not going to exit just if this dips down and hits that 70 level in this class. Okay, that's not what we're going to do. I'm going to put an exit at some point. And that exit you can base on the stock price, or we can just say, look, we can let it run. That's the reason why we do spreads a lot of times, is we limit the risk with the spread versus just doing say a 70 put. Okay, I have a choice. I could just do a 70 put on this, and what's my risk on that? Well, my risk on doing a single $70 put is going to be roughly $7,000. Okay, that's going to be my max loss on that. That would mean I'd be buying 100 shares of PayPal at $70 a share, $7,000 loss if the stock went to zero. Unlikely to go to zero, but that just gives you an idea of that. But let's say we do a 70, 68 short put vertical. What's my loss? Well, my theoretical loss limit would be the $2 difference between there, which is $2. Excuse me, $200. Well, $200 is a lot more manageable than $7,000. And so when you do, say, a short put vertical or short call vertical, you don't have to put in a stop there, okay? You don't have to put a stop there on that. Okay, question in the chat. Jose says, when you're doing these, is it important to look at open interest? What I'd say is it's important to check out the liquidity on these. Yes, so you can use open interest to do that. You can also get a sense by looking at the bid-ask spread, okay? The bid-ask spread. Well, here we have a 5-cent difference between the 127, 132. We've got 5 cents. That's fairly tight. So you can look at open interest as well on that to try and help. But this is kind of my go-to here, is look at how tight those spreads are. And don't just look at this contract, to look at other contracts, because sometimes it may tighten up real quick, but then you look at the others and they don't look so hot. In this case, it looks pretty good there along the way. Now, if we do putting an exit on this. Let's say we're going to do that 70. We say, well, 70 is kind of a support level. Probability statistics seem to be in our favor in terms of it closing out in that, even though we know there's a good chance it's going to hit that 70 somewhere along the way. I may put my exit in, not at 70, but maybe I'll say, well, I'm going to give it a little wiggle room here. I'm going to go below 70, maybe a couple percent below 70, maybe down to 68. And at that point, maybe we get out of that trade. So let's do that. Let's put in a trade here. I'm going to click on my bid price. I'm going to go, I'll do the 68. I'm going to control click on my ask price. Okay. There's my $2 wide spread. If I click confirm and send, by the way, you can see my max loss, $2 wide. It's $152. Now, why isn't it $200? Well, because I'm bringing in money up front on that. That credit, that initial credit kind of offsets the max loss on that. So that actually, I should have mentioned that earlier, because technically when I gave that example, the max loss wasn't $200. That's the most it could cost us to get out. But I didn't factor in either of my examples, the initial credit along the way. So technically the losses were a little bit less than what I said, but that's why some people are willing to let that go. Okay, there we go. So, there you go. And what I can do then, if let's say we put in that exit there. I'm not going to put my exit at 70. Let me go. I'm going to go to first trigger sequential. I'm going to right click on this. I'm going to create an opposite order, and I'm going to get out here at, we're going to get out at, I'm going to change this to market, good till canceled. I'm going to click on my gear, and I'm going to say we're going to get out if PayPal marks less than or equal to, say, 68. This is the underlying stock there on that, 68. Okay, yep. Here we go. 68. Okay, save there. Now, there's my price on this. Mid price 50, mid price 49, natural 45. Make it about 48 there, okay? So let me click on this and confirm and send, and we'll put this in our short verticals bucket, and we'll send. Now, I want to get to money management in general for some others, but I just want to give you, I'm going to give you a bearish example here, then we'll get to managing some various different types of trades. But right now, I'm focusing on short verticals. Let's do one that's maybe more on the bearish end of things. I'm going to pull up Dow. Okay, this isn't Dow Jones Industrial Average. This is Dow Chemical, Dow the company. And I'm looking at more of a bearish trade. Why? Well, the theory is on this, the trend is down. You can see our 50-day moving average sloping down, stocks below it. We see our 20-day moving average, that's in red. I also have a trend line in this kind of purplish color. Stocks below it, lower highs, lower lows. There you go. Okay. So same point. What I can do here on this is I can say, let's go out here, and we can go out further or less. Now, 29 days is certainly fine. If I go all the way out to July 18th, say, so those are monthly options. Now, going back to what Jose mentioned earlier, sometimes if you have more liquidity issues, let's look at open interest here, okay? Let's look at open interest on these. Here's my open interest. Let's compare here on this. My open interest on my weekly contracts, well, this specific expiration, compare that, okay? I don't need that many strikes. I'll do this. Compare that to this. And this is not atypical, folks. This is pretty common. And one reason why you're going to see those spreads tend to be a little tighter on your monthly contracts versus your weekly contracts. The nice thing about weekly contracts, of course, is that you have a lot of variety, a lot of choices about expiration. If I'm sticking with normal monthly expirations, I have 16 days to expiration or 44 days to expiration. Another nice thing on the weeklies is very often you get more strikes. Look, we got strike at 25, 26, 27, and so on. Here, they jump every $2.50. But I'm going to go with the monthly contracts here. So this is a longer period of time on this, okay? So Chuck said, is it a good idea to trade weeklies? There's no qualms about trading weeklies as long as the liquidity is fine and you know the expiration date on those, okay? Now, on some stocks, the liquidity is going to be just fine. You know, you trade Apple, it's not going to be a problem. Well, I can't make a blanket statement, I guess, but typically your liquidity on some of those like Mag 7 type stocks probably isn't going to be an issue whether you're looking at weekly or monthly contracts. You get some of these that are kind of, you know, it's a bigger company. It's an S&P 100 company. Sometimes you do see that distinction there, though, between those. Okay, so let's do this. Let's go, and we're looking at a bearish trade on this. Let me go back to my probability in the money. Well, let's do this. Okay, let me go theoreticals and Greeks. We're going to go probability in the money. Let's look at that probability of touching again. Okay, probability in the money. Well, look, this is one of the challenges. I got 2750, which gives me like almost 50-50 probability in the money, which is a little bit higher than we typically do in this class. I've got about 28%, which is, you know, a low probability in the money, which sounds good, but sometimes the premiums aren't very good when you do that. Okay, so let's go here and let's look here and see. Now we have more strikes. We can pick this 35%, which is kind of more often we'll look 30 to 40%, just kind of as a general guideline in this class. We typically look 30, 35, 30 to 40, somewhere in there percent for probability in the money, meaning it's a pretty good chance it's going to touch this 29 at some point. Well, let me put this in. Well, look, here, this is the point where I was trying to make earlier. Look at the bid-ask spread on this. So I'm not going to do this trade. I'm going to walk away from this trade. Sometimes, you know, it's like the Kenny Rogers thing. You got to know when to hold them and know when to fold them. This is one where I'm not even going to walk up to the table on this one because my bid-ask spread is 10, 20, it's 25 cents, which 25 cents may not sound like lots, but it's only $1. It's only $1 option or whatever. That's a pretty big difference on a dollar option. On a $5 option, 25-cent bid-ask spread doesn't concern me. On a $1 option, a 25-cent bid-ask spread does concern me. So that's where that open interest that we saw kind of comes in and can indicate those. But so I'm not going to actually place this trade, but let's just look at the technicals on this trade. We said 35% chance of it going in the money, but 76% chance of it touching. That's a 29 strike. What would the technicals look like this? Okay. Question on the open interest on this. Open interest was, you see that? See that? There's that correlation there between open interest. That's volume. I'm sorry. Here's open interest right here. Open interest is right here. By the way, common question, not one that's in the chat right now, but common question is, what's the difference here and here? Volume is just today's trading activity on this. that is probably less of a concern. In fact, I don't even normally look at the volume on that as the open interest. The open interest is the number of outstanding open contracts out there. But you can see that number isn't spectacular. And so Jose said earlier, what are we looking for on this? I don't have an exact number for you on that. It probably depends on how many contracts you're trading. If you're planning on trading 10 contracts and there's 50 in your open interest, that may be too low. If you're planning on trading 1 or 2 contracts and there's 50 in your open interest, that's probably okay. So I want, I don't know, but 30, 40, 50, somewhere in open interest, typically if I'm trading a few number of contracts. If I'm trading more, I probably want triple digits there. But I also like to look at that bid-ask spread. Okay, let's, what we said? We said we were going to look at, let me switch it one more time because I already forgot my strike I was looking at. We were looking at the 29 strike, okay, on Dow. So, I mean, here's our 29 strike. I realize I got a lot of lines on my chart here. 29 strike is about there. From a technical standpoint, seems like a reasonable trade. From the probability standpoint, seems like a reasonable trade. From the pricing standpoint, just not going to work. I'm going to walk away from that trade right now, okay? Now, let's talk about some trade management here. All right, let's see. Let me just look. Vicky Loves Florida says, can you exit early on a monthly? Yeah, you certainly can try and exit any of these trades early. There's no guarantee, absolute guarantee of a market on these. And sometimes what that translates to is you can try and get out of these, but the price, you may not like the pricing on those that you're offered on there. Okay. So if the underlying moves against you and you want to get out after a week, well, yeah, if the underlying moves against you, you can look to get out. But if let's say we're looking at this one again, okay? And we're looking here, and you see this is it's a moving target. I don't know if I have the same contract here. But let's say it moves against us here. So these are calls, and by against us means the stock would be moving up. If the stock moves up, what's going to happen to these call prices right here? They're going to go up as well. We're selling them up front. We're talking about selling this as a spread up front. But if the stock goes up and these prices go up and we want to buy it back, the answer is there's a decent, you can probably buy it back, but it's probably going to cost us a whole bunch. There is no absolute guarantee of a market, but usually you can buy it back, just not for the price you want. Okay, let me just go over one more time because there's a question in the chat on it, and I was probably a little terse in my explanation here in terms of the bid-ask spread. If you have an option that, say, is worth 50 cents, okay? Well, I'm going to call this my ask price, okay? And I'm going to call this a bid price. And this is true not just for spreads, this is true for any option. Let's say we're just buying a call or something, okay? And I buy that for 50 cents, buy at the ask price, and let's say my bid price is 30 cents. It means I can probably, no guarantees, the market moves all the time, I can probably pretty easily buy it for 50 cents, and I could probably easily sell it for 30 cents. Well, if I did that, I'm not going to assume I'm getting a mid price here on this, okay? Mid price. There's prices in the middle there too. But if I were to do that, I've just immediately lost 40%. I've just immediately lost 40% on my trade, even though the stock didn't even move a bit against me. Okay? Consider this. Let's say we have a $4 option. Okay? $4 option. And we have that same 20-cent spread. And my bid price is 80 and my ask price is $4. and I immediately sell it and I buy at the ask and I sell at the bid, what percent did I lose on this? I lost, what is that, 5%, I think? 5%. There's always going to be a difference here between these. And hopefully you can get filled at a mid price. But that just kind of illustrates why the price of the option, I think, is an important consideration when you're considering that bid-ask spread in there. Okay? So hopefully that answers your question there, Anthony. Now let's take a look here of some other trades we got. Here's one. I want to go to Alphabet, Google. What do we have on Alphabet here? I have 100 shares of stock and I have a short call. That is a covered call, okay? Covered call. We got 23 days to go till expiration. And what's happening on this trade? Well, we have the stock isn't doing great. We bought the stock for 172. It's gone down a little bit. So I got to decide, am I still bullish on this, first of all? One nice thing is on the put, so we've lost $600 on the call here. Excuse me, not on the call. We've lost $600 on the stock. The good news is we had that covered call in, and it's actually eaten into the loss. The loss is, or net loss is about 384 instead of 600 if we didn't have the call in there. But at this point, we traded this call initially for $3. It's down to about 90 cents. So we've made most of what we can make on this call. So there's a few questions when you're managing cover calls. One question is, how much time do we have till expiration on the call option? We still have got enough time. Number two, if I want to stay in this, I only want to stay in this if I'm still bullish on Alphabet. It doesn't make any sense to be in a covered call if you think the stock is going to go down. So are we still bullish on Alphabet? Well, let's take a look. And you may not think it's bullish. I'm going to consider this a reasonable level, though, for our purposes. I'm going to say, look, our trend is up. We're above our moving averages. Looks like we may be picking up a little bit of support here on this. So I'm going to stick with this trade a little bit longer on this trade for this reason. I'm still bullish on this. But that begs the question of, what do we do with the call on this? So one possibility is we could roll this out and possibly make some more money on the call. In other words, I could buy back this one for about $88 and sell a different one. Now, so let's look to do that, but let me just mention something. Right now, I have an exit order on this trade. I have an exit to get out of both the stock and the call option. Stock and the call option. If I'm going to roll this out, in other words, I'm going to change the strike price or expiration on the call option, I can't continue to just have my exit on here that is going to get out of this one, because I'm not going to be in this one anymore. So I need to cancel these. So what I'm going to do is I'm going to click on it. I'm just going to right click and I'm going to cancel that stop on it. Okay, there's my stop on that. So we've decided we're going to stay with the stock, but this call may not be the one we want to stick with here. So let's go to trade. Okay, and we can see, well, here's our position. Let me get rid. Well, we'll go here. Here's what we currently have on this. We're 23 days to go to expiration, and you can see this is a little ways out of the money. And I can go and I can roll this to a lower strike if I want, roll it down, bring in more money. I could also look to go to a different expiration date, July 3rd. So if I go to July 3rd and I look at these, and one thing I can do is, again, I can do what we did before. We're going to look at our delta as kind of a guide on here, maybe 30 delta, somewhere 20 to 30 delta. Here, this would, if we sold this one for about $216 or so. That'd be a nice credit. Because remember, we'd be buying back the one for approximately $88. We'd be selling this one for about $216. And that would mean if we rolled it, it would give us a credit of, oh boy, what is that? What is that number? It's going to be $1.28. Did I do my math right on that? I'm not sure. $1.28 per contract, per the multiplier of 100. That'd be $128 there if I'm doing my math right. And I make no guarantees of that in my head here, but that'd be a $128 roll. That doesn't factor in commissions. And keep in mind, when I say roll, there are commissions. When I say roll, effectively what we do is we're just getting rid of this one and we're adding this one in there. Okay, so let's do that here, just as our demonstration. So when I'm going to roll, you can just exit the one and you can just do the other, or you can use a rolling ticket order, which is fine. What you need to do is you just first need to realize which one you're doing. And we said we're going to do the 175 strike, July 3rd. That's what we're going to be rolling to. Does that make sense, though, from a chart standpoint? 175, that's up here. That brings the stock up to basically where our previous high was. If it goes up there, if it goes above there, well, we may be capping our gains. But it would turn at that point, 175 exit means our initial stock would be making money, plus we would have made the money from the call options, call premiums along the way. Okay. Greg says, can I still get the mid price? Well, we'll see. You can always do this. So what I'm going to do is let me show you here in a sec. I'm going to right click on this. I'm going to create a rolling order, and I'm just going to click on that. Okay. Here we go. Now it doesn't know what date I want to or what strike I want to. It actually picked the right date for me. Usually it's probably not going to. Usually you're going to have to change this date right here, but it happened to put it in on July 3rd. Didn't give me the right strike though. I'm rolling this down actually to 175. Here's our credit. Mid price 130, natural price 127. So Greg's question is, can I get the mid price on this? The answer is probably not. Probably not. Can I do better than the natural price? The answer is probably. There's no definitives in what I'm going to tell you right here because we just don't know. This is paper money right now. So I don't, but in real life, it's just going to be a matter of if somebody's willing to buy it for or sell it to you for this price. Okay. So often what we'll do is we'll go in between the mid price and the natural price on that. Okay. So what I'm going to do here is I'm going to say, we'll go here 129 and I'm going to confirm and send, and I'm going to send that order. Okay. So we just rolled that out. Let's take a look at what it looks like here. Now, why do we call it rolling? Well, look, here was the initial trade. We had this one, and now we have this one. Once this disappears, and this will disappear after today, it will just look like this. Kind of like what we had, except it's just different expiration date, different strike. We brought in a credit along the way, which helps, okay? Which helps. That's great. And there we go. Okay. So that's rolling. I'm hoping that makes sense, folks. Hoping that makes sense. Now, can we still put in the exit on that? Yes, we can. We can put in the exit. We just got to decide where we want to exit here. We can say, well, look, if this drops down to, I forgot what we had before, I could double check. But if we're going to say, we think it's going to bounce here, for example, if we think it's going to bounce around 165, 164 range, I'm going to give it a little wiggle room here, a little bit below. I'm going to go about 2% below that, maybe about 162. And if it goes down there, maybe we'll just get out if we hit 162. Okay. So how do I do that? I can go here. I can right click on it. I can create a closing order. And this is going to get us out. Market. Now, technically, this is not getting us out if the stock hits 162. Technically, this is getting us out if the combined price of the stock and the call, if we did it based, sorry, let me back up. If we did it based on this price and just did a stop, if I did stop and did it on this price, this would be the combined price of the stock and the option, okay? And remember, stops aren't guaranteed. If I go to market good till canceled, market, good till canceled, and put in a rule and say, if Alphabet marks less than or equal to 163, this is just the price of Alphabet there, okay? Save, confirm and send. Make sure you read all the red stuff on here, okay? And let me I just want to double check. Market good till canceled. Okay, confirm and send. Send. That order is in, and now we have a new stop order on that. So hopefully that makes sense, everybody. That was Alphabet. I wanted to manage that one. Let's talk about managing a different type of trade here. Here's Oracle. This is a trade that actually is going real well on us. What is it? We have a 150 call, long call. We have a 150 short put. This is calling it a combo. This is really a long synthetic. Okay, this is a long synthetic trade. It's been doing great. It's a bullish trade. And as you'll see here in a sec, Oracle has been doing what we had hoped. We have an exit on this though, okay? Let me, hold on. Let's see what we got in terms of Oracle. Been in it for a little while. Oracle, our condition is to get out if it goes below 139, okay? 139. So, is 139 still appropriate on this? I would submit no, probably not. This is going to get us out if the stock goes down here. Well, I'm confident in saying this is a support level that we could probably put a stop below that. So I'm going to put this around 153. If we go down to 153, we're going to look to get out of this trade. So what I'm going to do here is I'm going to move my exit up. So what I'm going to do is I'm going to click on this. I'm going to right click. I'm going to cancel and replace this exit order to exit. And we said 153. So I'm going to change this gear. Instead of 139, we're going to make that 153. We want to capture in gains here. Confirm and send. I'm going to send that order. It canceled the other one. And now we've effectively moved that stop up here on this. Okay, not technically a stop. Technically, it's a rules-based order, but that one's going well. Now, so that was, how much? We're up $1,700 on that. Well, we don't win them all. There's going to be some that we're not doing so hot on. And in fact, I have one here. Here's a trade that is not looking so great. Here's DHR. We're down almost $200 on this trade. This is a long vertical spread. Well, clearly something's not going well on this because our PL opens way down on this. This was a long put vertical, 195 put, 182.50 put, which means our target, and I'm running out of time here, our target is 182.50. Well, let's take a look at this. Let me go here. Are we bearish on DHR still? The answer is probably not bearish enough at this point. At this point, I think we're just going to cut our losses. Sometimes it's better just to lick your wounds and exit the trade. So what I'm going to do is I'm going to cancel my stop on that, and I'm just going to get out of this trade here. Okay. Hold on. There we go. Okay, we're going to cancel that, and I'm just going to exit this whole guy. Right click, create closing order. We're going to get out of this vertical. And again, mid price, natural price, we could probably get a little bit better than the natural price. Maybe not the full mid, but I definitely want to get out of this here. We're going to get out of that and cut our losses on that trade. All right, everybody. Thank you very much. I'm out of time. But coming up next, we have Trading Price Patterns. Barb Armstrong teaches that class. It's a great class. Make sure you check that out. Hopefully it was helpful today. Today we talked about probability of expiring in the money versus probability of touching and exiting on short verticals. We also talked about managing some of these individual trades along the way. Thank you, Ben, in the chat. Always helpful. Everybody, thanks for joining me, and we'll see you same time next week. Bye-bye, everybody. Oh, there's a survey link as well. Bye-bye, everybody.